So you are looking at SoFi? And what does Wall Street tell you? Hold. Some analysts are even calling for a major crash from here. The consensus price target is hovering around $20 to $22, which suggests a potential drop of more than 20% from where it is trading today. They look at the stock and all they see is a risky, high-flying fintech. But I think they are missing the forest for the trees. I am about to break down the one critical thing their models are getting wrong, and then I will share my personal playbook for what I see as a multi-bagger in the making. Let us understand the bear case, because you have got to respect both sides. The main knock against SoFi is its valuation. Analysts will point to its price-to-earnings ratio, which, let us be honest, is way higher than most traditional banks. They see the stock's incredible run-up and just assume all the future growth is already baked into the price. And with that, they slap a hold or even a sell rating on it, basically saying it is dead money from here. They are looking at SoFi through an old-school banking lens, and frankly, that is just the wrong prescription. It is leading them to think the stock is overvalued, when they really just are not looking close enough. The huge flaw in the typical analyst model is that it completely underestimates the power of SoFi, its business, and its relentless execution. They're stuck looking at static numbers on a spreadsheet, not the story those numbers are telling. And that story is about three things: explosive member growth, the magic of the cross-sell flywheel, and a shockingly efficient profitability machine. First, let us talk growth. In the second quarter of 2025, SoFi pulled in a record 850,000 new members. That is not slow growth. That is a land grab. This pushed their total base up 34% year over year to 11.7 million members. And these are not just empty accounts. Total number of products our members are using also shot up 34% to over 17 million. This company is not just collecting users, it is building deep relationships. Which brings me to the most important point: the cross-sell flywheel. CEO Anthony Noto's strategy is simple. Be the one-stop shop for every major financial decision in your life. Someone joins for a student loan, and before they know it, they are being introduced to SoFi Invest, SoFi Money, and credit cards. It is an incredibly sticky ecosystem. The more you use, the less likely you are to leave, and the more profitable you become. That is a real competitive advantage that a simple price-to-earnings ratio just cannot measure. Finally, let us talk about the profitability machine. A lot of analysts are stuck in the past, thinking SoFi is just another fintech burning cash. But the reality is, SoFi has now delivered 7 consecutive quarters of GAAP profitability. In the second quarter, adjusted EBITDA skyrocketed 81% year over year, with margins hitting a beautiful 29%. That shows insane operating leverage. As revenue climbs, the costs barely budge, meaning profits just accelerate. That is the signature of a scalable tech platform, not some stuffy old bank. So while analysts are fixated on today's price-to-earnings ratio, they are ignoring the avalanche of earnings growth that is right around the corner. Before I show you how this all translates into my personal price target and my exact play here, do me a quick favor and hit that like button. It really helps the channel and tells YouTube you want more breakdowns like this one. So how am I looking at SoFi's valuation? Well, the bears are clutching their pearls over a high price-to-earnings ratio. I see it as a fair price for this kind of disruptive growth. But do not forget, management is guiding for long-term revenue growth of over 25% and is targeting earnings per share between 55 and 80 cents by 2026. If SoFi just hits the high end of that guidance, the stock will be trading at a much more reasonable forward multiple, especially for a company growing this fast. The market is slowly starting to get it, but the analyst community is still lagging behind. Then you have catalysts that are barely even being talked about. There are reports that the government is considering privatizing parts of the federal student loan portfolio. If that happens, it would be a massive tailwind for SoFi's core refinancing business. And CEO Anthony Noto has already made it clear they are ready to jump on that opportunity. So here is my personal play. I do not see SoFi as a stock to trade. I see it as a long-term investment in the future of finance, a fintech super app in the making. The consistent execution, the expanding margins, and the monster cross-selling opportunity give me all the conviction I need. While analysts are stamping hold on the stock with targets that imply a 20 to 30% drop, I see a clear runway to major upside over the next few years. I am holding my shares with conviction, and I will be looking to buy more on any big dips caused by this short-sighted analyst chatter. This gap between Wall Street's story and SoFi's actual performance is where the opportunity is for us. They see risk. I see a company that is flawlessly executing its mission to become your financial everything. And that is a bet I am willing to make. Now I want to hear from you. Let me know what you think in the comments below. Are you buying, holding, or selling SoFi?